Welcome back to Real Estate Economics Weekly Webinar Series. This week the topic is Santa Clarita Valley. This is part 2 of 2. In this section we're going to be addressing market coverage trends and pockets of opportunity that we've identified in this market as of September 2010. Anytime you have a market, as we addressed in part 1, where the number of active communities has contracted in the past several years from about 45 to about 11 currently, you start to see holes in the market in terms of homes available at a price range, at a unit size range, and with different configurations. This area is absolutely no different. As the market coverage thins out, what you start to see is not the worst size ranges, price ranges, and unit sizes that become thin, but the most vibrant, the most in demand, the strongest price ranges, the strongest floor plans, the strongest house sizes are the ones that disappear first and tend to leave the weaker performers. Now, when we talk about market coverage, what we're saying is how well is the available inventory distributed. We talked about the locational market coverage in section 1. In this section, we're going to talk about price range coverage. Now, if you look at this particular table, the market at present only covers the range from $250 at the most affordable end up to $650. There are no homes in this market above $650 at this time. Now, you might think that's a good thing given the economic conditions, but normal coverage would suggest that we might have something a little bit higher. Number of floor plans is in the first column just to the right of the price range. That's the number of floor plans that are in each of these categories. The first thing that jumps literally off the page at us is that there are only 2 active floor plans being sold at $325 to $350 price range, and there's only 2 at $375 to $400. Those are real bread and butter, down home price ranges that we would expect a lot more floor plans to be active in. Now think about this: if you've got a real viable price range, let's call it $400 to $450, and you want a 2-bedroom home, but the 4 floor plans that are out there are only 3-bedroom homes or 4-bedroom homes, that's not going to meet your needs. What if it's a 2-car garage and you want a 3-car garage? What if it's a smaller lot and you want a larger lot, or it's all 2-story homes and you want a single-story home? All those are disqualifying factors that suggest to us that you need more than 2 or 3 or 4 or even 5 or 6 floor plans in each of these categories to give buyers the number of choices that they really want. Look at the center of the screen. It shows units available. So that's the number of units that are currently offered, not in future phases now, but are currently available for sale, that have been released or are under construction in currently active phases. There's only 2 floor plans, 2 houses in the $375 to $400. There's only 3 houses in the $450 or $400 to $450. So if you're going to buy a house, even if it's the perfect house for you, you can find the perfect house. All the rooms sync up, the bathrooms sync up, the garage syncs up. There's only 2. If you don't like that one, you're going to have to wait for that home to be built. On the far right-hand side of the table in the blue letters is sales efficiency rankings, and what that means is how does that particular price range rank in terms of its percentage of sales compared to the percentage of floor plans that are in that rank. So the highest numbers, the number 1, 2, 3 with a small blue asterisk at the extreme right-hand side of the page, those are the most efficient price ranges. Sales exceed the number of floor plans that are in that particular range. So you can see 1, 2, 3, 4 all in the middle of the market, 375, but most of the areas have fairly decent numbers, and if you look at the sales per plan, there's a number of categories where the average plan in this group can sell more than half a month, more than 3/4 a month, up to 0.86, almost 1 a month. We should be able to create a viable program out of sales rates of that size. Let's go on to market coverage by unit size. Again, what jumps off the page here, 2,000 to 2,249, there are 2 a total of 2 active floor plans across this huge geography. 14 corridor across to 5 corridor, 2,000 to 2249 ought to be a highly populated unit size range with single stories, 2 stories, 3, 4, and 5 bedrooms, 2 and 3 garages on a variety of lot sizes. Instead, we have just 2 houses. 3,000 to 3249, we have 3 houses. Even if you take the most highly populated size, 3250 to 3499, I would expect that unit size range to have a variety of bedroom counts, a variety of bath counts, different stories, different garages. Let me call your attention to something else. Go to the far right hand side of the screen where the blue 10 is. If I have high performing unit size ranges above and below a certain range that's underperforming, I'd call this 10 a sign of underperformance. There's only 4 floor plans there. Almost always we can identify a factor in one or more of those floor plans that tells us it's not resonating with the buyers, people are not responding well to it, and there's some reason why that particular size range isn't working well. And we'll be able to look to that, identify some factors there, and see if there's some opportunities. Again, this market shows few units available in many of these categories, and probably a number of opportunities. Let's go on to bed and bath counts. The first thing that strikes me here is look at the 3-bedroom, 2-bath. That's a real conventional single-story floor plan. This is a townhome, so there's only 1. There are no 4-bedroom, 2-baths. As I mentioned in part 1, this market area has no single-story floor plans available at this time. Look at 5 bedrooms, 3 baths. That would probably be the 3rd or 4th most popular floor plan regionally. It's not under production in this market at this time. Look at the 5-bedroom plans. We have 1 plan at 5 bedrooms, 3.5, 1 plan at 5 bedrooms, 4 baths, and as I mentioned, no plans at 5 bedrooms, 3 baths. So clearly, we have very poor supply levels in the larger homes. Now, some of these homes might be expensive, and that's pushing builders away from them. But if this market's going to perform as it should, given its size and its income capabilities, it's going to need much deeper supply and vastly improved market coverage. Let's see how this plays out on the ground. This particular graph shows the I-5 side of the valley, detached programs only. On the x-axis is the living areas, are shown from 1,600 to 3,800 square feet. The y-axis is the prices, 350 up to 650. The dots are color coordinated by community, so the red dots are all the 3 floor plans in one community. So if you look at this side, the I-5 side of the Santa Clarita Valley, detached homes only, we have a total of 3 active communities offering 7 floor plans. What jumps out to me in this sort of a scenario is look at the 1,700 to 2,700 square foot price band. We have 2 floor plans. There is 1 house in this market under $500,000. That's it, 1 house. Look at the 2,800. There's 1 house at 2,800 and another house just under 3,400. So between 2,801, let's say, and about 3,390, we have 1 floor plan. If you look at this market, even if these are the best floor plans in the world under competent sponsorship, competent ownership, there's going to be features about these plans that don't resonate to all buyers. It's like going to a car dealership and they have 1 model and 1 color, going to a restaurant where they have 1 dish. It's almost impossible to generate the type of market capture you want with a single floor plan. It's got to resonate perfectly to the buyers who do select it. In most cases, people are going to say, you know what, I'm going to the resale market, I'm going to wait, I'm going back to the sidelines. It's very difficult for a market to perform up to its full capabilities with this level of market coverage. So how does that manifest itself? How does that work itself out in the real market? Here's our estimate of distressed inventory levels for the Santa Clarita Valley at present. Shown in purple is the notices of default. pink is foreclosures, and green are foreclosure sales. If you look at 2011, 2012, 2013, we have about 1,000 foreclosures and 1,000 foreclosure sales per year. This is a market that's running about 500 sales a quarter, so the total foreclosures would be about half of the annual inventory. But if there's no new home supply and the demand is really being channeled back into the resale market, it's unlikely that these distressed homes are going to last long. Anything that's decent in a good area, well maintained, is going to immediately be swooped up by buyers. I would bet that these numbers don't hold up and come down much faster than we're anticipating. And one final thought, as confidence returns to the economy, people are going to be much less likely to strategically default, regardless of government programs to prevent that. And to the first sign of hope, I think people will undertake greater efforts to keep their homes. You can see in the demand distribution in this particular market area, this shows the active price ranges for the current period in light blue, 1 year ago in green, 2 years ago in yellow. I show this because you can see the demand migration down into lower price points. 2 years ago, we still had some weakness in our underwriting, and buyers could stretch up to acquire the larger home. They could jump up to your price range because there was no correlation between the loan they could acquire and their incomes. Those factors have completely disappeared from the market, and now the market share under 400,000 is grown a lot. I show at the bottom of the chart the market share over 400,000, which has gone from 46.8% 2 years ago, almost half of the entire market was over 400, to now just a third. In this economic environment, taxes appear to be going higher. Disposable incomes are likely to be under pressure. Incomes we already know are under pressure. Employment looks like it's positioned for a slow recovery. Homes are simply going to have to be built down to buyers' realistic financial capabilities, because their ability to jump up to higher price ranges is seriously compromised. In our previous webinars, we've talked several times about using other indicators besides home sales, besides home prices, besides the same thing that our competitors and the public and millions of other people are looking at. We've pointed out lumber, so I have to have a little sidebar on lumber here. This is a current lumber chart, and if you notice in the right side, this is on the Chicago Mercantile Exchange, 2x4 lumber, framing lumber if you will. We've had a little spike in lumber prices starting in about mid-September, so I've fielded a couple of calls on this. We've suggested, and lumber has very effectively predicted, changes in market sentiment, changes in builder demand over time. So we've used this. We doubt that this little spike up in lumber is anything serious. The volume has not grown, so we're going to keep our eye on this, but I don't think it's suggesting any sudden improvement in the market. That's further confirmed. This is a lumber exchange traded fund on the stock exchange. This hasn't shown any sign of upward movement, so we don't think there's anything significant in the lumber market at this time. Let's draw some conclusions about this. This market is still showing slow new home sales and weak pricing power. However, with this level of market coverage, the demand, it just isn't being met. Buyers who are interested in new homes, those who can qualify with good job conditions, are either moving to the resale market or being held off, pushed to the sidelines, if you will, waiting for new opportunities. This lack of new home market coverage is going to feed the resale market and accelerate the disposition of distressed inventory, particularly those homes that are reasonably well cared for and in good condition. We believe, and you can prove through a comparison of incomes and home prices, that this market is overcorrected and is significantly undervalued, and once we have a change in confidence, that will reverse. Our opportunity risk index suggests this market will perform well in the next cycle. This area has traditionally outperformed on an employment basis, and we think it will continue to do so. Too high of dues and assessments are discouraging this market, and we'd like a planned community-like concept where lower amenity levels and community definition minimizes ownership costs and opens up demand at lower price ranges. I'm John Mulville. Thank you for joining us today. Please call us with any questions.